Good afternoon, and welcome to another educational video from Blue Sky Trading, where we strive to teach you everything that you need to know to become a successful trader. Today, we're going to be talking about how to make money trading like the pros. So what does that mean? We're going to show you how to move from a retail trader mindset to using the same techniques and strategies used by the professionals. It's a common statistic, or a well-known statistic, that over 90% of traders end up losing money in the market. In this video, we're going to show you how to avoid being part of that 90% and how to move into the group of 10% that actually makes money consistently year after year after year. So let's start off by defining what is success. So this quote from Alexander Elder pretty much sums it up for me. The goal of a successful trader is to make the best trades. Money is secondary. The problem with a lot of beginner traders is they're so focused on making a profit on every single trade, and that's just not realistic. Even the best traders are only profitable or only correct on maybe 60 to 70% of their trades. The way they ensure that they're making money is by proper strategy and risk management techniques, so that even on the trades where they're wrong on, their losses are very small. So focusing on the trades instead of the money, focusing on making the best trades, is where you're going to be successful in the long run. Now, what does that mean by the best trades? Well, that means taking the trades that have the highest probability of success. So, how to trade for consistent profits? Well, first of all, the key rule in this is don't allow wild swings in your account balance. I'm going to show you what I mean by that. Your account balance over time should look something like this, right? It should be gradually moving up, so that if you draw some trend lines for your account balance, you can see it starts off in the bottom left-hand corner of the screen and it's continuously moving to the top right-hand corner. And that's what you want to see. You want to continuously be making profits year after year with small pullbacks. Now, of course, like I mentioned, you're not going to be correct on every trade. It's just not possible. That's just trading, right? You're going to be wrong on certain trades. But you want those losses to be small. So you want these pullbacks to be small, and overall, your balance still increasing. Now, what you don't want is your account balance to look like this, right? With large swings. Now, there's two reasons you don't want this. Number one, if you're taking huge losses, okay, so if let's say you're taking 20, 30%, maybe even 40 or 50% losses. If you take that big of a loss in your account, look, there's no other way to say it. If you're that bad of a trader that you're going to lose 30% of your account, what makes you think that all of a sudden you're going to be a good enough trader to make it back? And just think from the math perspective. If you lose 20% of your account, you now have a smaller balance to work with. You now have to make a profit of 25% to make up for that 20% loss just to get back to even. So that's the first issue. Second issue, taking big losses tends to lead to more losses. The reason for that is just the psychology of trading. When you take a loss, especially if it's a pretty big loss, you now have a smaller account balance. So now you're trying to make your money back with a smaller balance. So what do? You start taking bigger risks. You start throwing risk management out the window. The bigger risks you take, you start taking even more losses. Pretty soon, you don't even have enough money left to continue trading. So how to avoid that? Look, in my opinion, I think there's three things that you need to master in order to trade successfully and consistently over long periods of time. The first is strategy. You need to have a strategy that's tested, reliable, and that you can consistently apply over and over again to various charts. Next, you need a risk management plan. This is often overlooked, but you need a risk management plan that's personalized for yourself and that you can stick with to make sure that your any losses that you do take remain small. And third, you need to master the psychology of trading. And this by far is the most difficult. So you need the right, you got to understand the psychology of trading. You need the right mindset when you're trading. Now these percentages that I have up here, the 15, 25, and 60% respectively, those don't indicate how important each one of these items are. They're all equally important. You need all three of these working together in order to consistently make profits. If any one of these is missing, your trading is not going to work. Okay? If you don't have the right strategy, you're not going to be getting in the right trades. If you're not using risk management, you're going to be taking big losses. Similarly, if you don't have the right mindset for trading, you're not going to be successful over the long term. What these percentages indicate is the difficulty level of mastering each one of these. So strategy is the easiest to master, in my opinion. Risk management tends to be a little more difficult just because people don't think of trading from a risk management perspective. And by far, the psychology of trading is where most people struggle. So in this video, we're going to go over all three of these, but we are also going to make separate videos on each one of these items. It's just too much information to include in one video. So we're going to be making separate videos, and as those get published to our channel, please come back and look down in our comments section. We'll be posting the links to each of these three videos down in the comments below as we get them uploaded. So let's take a look at strategy. So what is strategy? It's basically just a set of rules and conditions that you follow every single time you take a trade. Now, it's okay to follow, 2 or 3 different strategies, but you don't want to be trying to trade everything. Okay, you don't want to be trying to trade, double bottoms, head and shoulder patterns, breakouts, pullbacks to the moving averages. You can't be a master of everything. You want to pick, 2, maybe 3, if you're really good, maybe 4 strategies, but you want to pick a limited number of strategies and get really good at them and be able to apply them consistently to every single chart every time you do it. Look, if you look at a chart, pick any chart you want, pick your favorite ticker to trade. If you pull up that chart today, and if you ask someone, based on today's price, what do you think, where do you think this chart's going tomorrow or in the next week? Look, I have no idea. Nobody does. Nobody knows where the market is going to go next. And if anyone tells you they know which direction the stock's going in, they're lying because they don't. Nobody knows what the market's going to do. So the purpose of a strategy is to have a defined set of rules that help you identify patterns in certain stocks that have a high probability of moving in the direction you're expecting it to move in. Look, most charts, when you look at them, are just random movements in stock price. It's only when you recognize a particular pattern that it's worth taking the trade. And that's what this strategy allows you to do. So your strategy must be specific enough that there's no subjectivity on when to enter the trade. It must be 100% objective. Look, you don't want to be trading emotionally. You want to make trading as mechanical as you can possibly make it. Your decision should be a binary decision. Either yes, I'm getting in the trade, or no, I'm not getting in the trade. So you look at the chart. If you identify a certain pattern, if you identify all of your conditions in your strategy are met, and then you see your entry signal, you take the trade. If any one of those things are missing, you don't take the trade. It's really that simple. Now, your rules need to be easy to follow. You don't want to have, 15 or 20 different indicators that you're looking at. You want to have a limited number of indicators, enough that you can easily make a decision, enough that you can tell, that you have enough indicators that you can tell that with high probability which direction the chart is going to move in, but you don't want to overly complicate it. Okay, a typical beginner mistake is if someone's struggling, losing money, what do? They add more indicators. You don't need more indicators. You need just the basic indicators, and what you need is a good strategy on how to use those. The final point, your strategy must include an exit. Now, that's in both directions. So let's say you get into a trade, you're now long a stock, right? It met all the criteria in your strategy, you went long, and now you're profitable. The stock moved up. So what do? That's great. I mean, it's great you're making money, but now what? Are you going to hold it too long and your profits are going to turn into a loss? Or are you going to sell too early? So let's say you're up 5%. You think, oh, great. I made 5%. I'm going to sell. And then next week, the stock's up another 20%. So you need to have a strategy on what you're going to do as you become profitable. Equally important, you need an exit strategy if the trade doesn't work out. So like I mentioned before, even professional traders and the strategies they apply, they're only right maybe 60 or 70% of the time. So that means 30 to 40% of the time the stock is moving against them, even though it met all the criteria of their strategy. So you need to make sure that you're limiting your losses. You need to have a plan in place and an exit strategy on where you're going to say, oh, I guess I was wrong, and you're going to get out of the trade. So basically, you should never enter a trade unless if you can clearly explain to somebody why you're getting in and also what your strategy is for getting out, either profitable or at a loss. Next, we'll look at risk management. So risk management is often overlooked by beginner traders. Look, it's not a very exciting topic, but it's absolutely critical if you're going to be successful in your trading. So most traders only focus on potential profits, right? They're just looking at the reward side of the equation. They don't fully appreciate the risk that they're taking every time they open a new position. Risk management is really what separates traders from gamblers, okay? Risk management is what's going to prevent those wild swings in your account and keep the pullback small and keep you moving in an upward direction. Risk management is what separates retail traders from professional traders. Now, for every entry that you take, for every position that you take, you know what your exit strategy is. You need to know, based on your position size, what is the worst case scenario if you do get stopped out. How much money are you going to lose? Not only that, if you have multiple positions, say you have 3, 4, 5 positions open, you always need to know what is the worst case scenario if, let's say tomorrow, the entire market pulls back and now every one of your stops gets hit. How much money are you going to lose? Look, you need to know what that number is, and you need to be okay with that number. That number needs to be such that if you do lose that amount, you're going to be okay with it, and you're still going to be able to stick with your strategy and your risk management plan and get back in the next time you see a stock that meets your criteria. When it becomes an issue is when that loss is too big. And now it triggers an emotional response in the trader, and they start to deviate from their strategy or their plan. So you need to know what that number is. You need to know what your maximum risk is at any time, at any day, and you got to be okay with that maximum risk. All right, so moving on to the psychology of trading. So like I mentioned, in my opinion, this is by far the most difficult item to master. So the first two that we talked about, putting together a strategy and a risk management plan, look, both of those are based on intellect, okay? And when I say intellect, I'm not talking about, it's not rocket science. You can watch YouTube videos, you can Google articles. There are countless strategies that you can use to trade, okay? What you need to do is you need to figure out which one works best for you and then stick with it. But it's really not that difficult. Same with risk management. Once you understand the components that go into a risk management plan and how to personalize it for yourself, it's actually very easy to put together. The most difficult is the psychology of trading. It really requires a mindset change. Trading is not natural for humans. The emotional responses that happen during trading are completely counterintuitive to what you should be doing. The problem is, when you're trading, you need to completely detach your ego from trading. Look, you're going to have losses, okay? You are not going to be correct on every trade. If you're correct, 60 to 70% of the time, you're doing really well. But that means you're going to be wrong 30 to 40% of the time. People don't like to be wrong. It's human nature not to want to be wrong or not to want to admit that you're wrong. Now, studies have also shown that people with higher intellect tend to make worse traders. It seems counterintuitive, but when you really think about it, people with high intellect are used to being correct. They're not used to being wrong. Okay, so nobody wants to admit that they're wrong, but studies have shown that people with higher intellect have a bigger emotional response to being wrong, which seems to make sense on, why they don't trade as well. So you really need to detach your ego from trading. You need to accept the fact that you are going to be wrong on certain trades, and you just have to trust your risk management plan to make sure that those losses when you are wrong are going to remain small. You need to ask yourself this question. Look, do you want to make money or do you want to be right? Because you're not going to be right in trading on every trade. So if your answer is you want to make money, then trust your strategy, Trust your risk management plan and be okay with being wrong when the trade goes against you. Look, it's the number one reason why people fail at trading. If you're not able to master the psychology of trading, you just won't be able to consistently follow your strategy or your risk management plan. If you start getting emotional, you're going to start deviating from your strategy. You're going to start moving your stops, changing your risk management plan, and it's going to result in bigger and bigger and bigger losses. So it's something that's absolutely key to manage, or absolutely key to learn how to implement if you want to be successful at trading. So, trading for consistent profit. Look, trading is not a get-rich proposition. You're not going to become a millionaire in the next year or even in the next couple years. Unless, of course, if you're starting with $1 million in your account. But I still believe, or at least it's my opinion, that trading or investing in the stock market is still the best way to build wealth over time. I think it's better than any real estate or any other investments. However, that's only true if you master these 3 critical steps of strategy, risk management, and the psychology of trading. If you can do that, if you can master those 3 critical steps, then what you're doing is you're treating trading like a business and no longer like a hobby. Think of the analogy of, an entrepreneur starting up a new business. You shouldn't just go into it blind or without any kind of plan. At least you shouldn't. If you're starting a new business, you know what your risk profile is, right? You know how much money you're going into the business with, and you have a plan. You put a business plan together before you even go into it. Trading is the same way. Before you even make a trade, you have to know what your strategy is, and I'd recommend writing it down. Write down what your strategy is, what your criteria is for getting in the trade. Same with risk management. Any new business owner knows what their risk is, how much money they're investing, what they could possibly lose if their business doesn't work out. Same thing in trading. For every trade, you need to know what is your maximum risk if the trade doesn't work out. If you do that and you treat trading like a business, you will be successful over time. There's no way that you wouldn't. So that's all we got for this video. I hope you enjoyed that. I hope you learned something from this. And like I said, we are going to be doing 3 additional videos, one on strategy, where we're going to talk about the step-by-step process on how to build your strategy. Like I mentioned, there's all kinds of strategies you can get from YouTube or online, but how do you take that and customize it to make it your own, so that you have your own set of criteria and your own strategy that you're confident in trading? So we'll have a video on that. We'll also have a video on risk management. Similarly, look, everyone has a different risk profile. You want to be able to develop a plan that works for you, that you're comfortable with, and that you can stick with. So we'll have a video on how to put a risk management plan together. And then finally, we'll have a video on the psychology of trading. And again, this is something that you really need to master. We're going to go over what some of the more common, emotional responses or fears of traders that end up impacting their trading. We're going to go over that in that video. So once we get those posted, we'll check back here in the comments section. We're going to post links to all 3 of these videos down in the comments. And again, hopefully you enjoyed this. If you did, please hit the like button. If you subscribe to our channel, then you won't miss any of these other videos that are coming up. Hopefully you enjoyed this video, and we'll see you next time.